Welcome to GL Advisor's presentation prepared specifically for medical students and residents. GL Advisor was created with three primary objectives in mind: lowering the cost of your debt, providing payment relief during residency, and saving you time so you can focus on your career in medicine. The goal of this presentation is to share information that will assist you in making more educated and informed decisions about your student loan debt, and ultimately to help you maximize the savings opportunity available to medical graduates who follow the proper action plan. Before we get into the core of the presentation, let's take a look at the recent rise in medical student debt. As you can see, the average cost of your education has more than quadrupled in the past 20 years, with the total debt averaging $220,000 for 2013 graduates. Many graduates have accumulated over $300,000 in recent years. Recently, the government created two repayment programs that can greatly benefit medical graduates who follow the proper action plan. The first is Income-Based Repayment, or IBR, which limits your monthly loan payments to 15% of your discretionary income and provides a subsidy to prevent additional interest from accruing on the subsidized portion of your loans while you are in IBR. Additionally, there is a component that forgives any outstanding balance on your eligible loans at the end of 25 years. The other repayment program available to medical graduates is the newer Pay-As-You-Earn program, which functions exactly like IBR with two exceptions. If you're eligible for Pay-As-You-Earn, you'll only pay 10% of your discretionary income versus 15%, and loan forgiveness on outstanding balances is forgiven no matter what after 20 years versus 25. Only graduates who didn't have an outstanding balance on a federal student loan before October 1st, 2007, and also received a federal student loan after October 1st, 2011, qualify for this program. It's important to note that if you qualify for and enter either IBR or Pay-As-You-Earn, your loan payments will be based on your income, regardless of how much debt you have. Also, once you enter either program, you cannot be removed from them. If your income rises to a level that no longer qualifies you for a partial financial hardship, your payments will be capped at your 10-year standard monthly payment that was established when you entered IBR or Pay-As-You-Earn. This slide shows how to calculate the partial financial hardship for IBR or Pay-As-You-Earn based on adjusted gross income, or AGI. Your AGI represents your income after certain deductions on your taxes, such as retirement account contributions. From AGI, 1.5 times the poverty level of your tax filing status is subtracted. This chart shows what payments in both programs should look like for a resident with roughly a $49,000 annual salary. The reason 6 months is shown here is due to the fact that residency typically begins in July. So in the year of graduation, only a half year's salary is earned. This should be reflected in your payments if done properly. Now let's look at an actual example. Here we are looking at a borrower who has an intern salary of $48,000. Under the standard 10-year payment option on $220K of federal student loan debt, the borrower would pay $2,525 monthly, more than 80% of his or her take-home pay. Under a 25-year extended repayment option, the borrower still pays $1,500 per month. Ultimately, both options are untenable. Now, seemingly the only option is forbearance, to postpone payments while in training. Under forbearance, the average medical resident in a 4-year program accrues a total of nearly $65,000, almost the cost of an additional year of medical school. After residency, this accrued interest is added to the principal loan amount, and therefore the new standard 10-year monthly payment increases to over $3,000 per month. However, if this same borrower utilizes IBR, the monthly payment would be reduced to between $0 and $400 per month during training. In this example, the borrower makes payments of over $10,000 during training, shown in yellow, and receives over $3,000 of subsidy benefit, shown in green. Accrued interest in this scenario is less than had they chosen forbearance, making IBR a financially superior alternative separate from any forgiveness opportunities, which we'll discuss shortly. In the next example, the borrower is eligible for Pay-As-You-Earn, so the payments during training are slightly less than IBR. After 4 years, they pay nearly $7,000 and receive a slightly higher subsidy. The other program that is available to medical residents is the Public Service Loan Forgiveness Program, also known as PSLF. The two important requirements for PSLF are: the borrower must make 120 qualifying payments on a federal direct loan whilst working full-time for a public service entity, defined as any federal, state, or local government, or a nonprofit 501c3 organization. Qualifying payments include IBR and pay-as-you-earn payments, even if your payment is set at $0 in your intern year. Since approximately 80% of hospitals are nonprofit institutions, a very large percentage of medical residents can qualify for PSLF. Using the previous borrower example, let's take a look at the value of the Public Service Loan Forgiveness Program when used with IBR or pay-as-you-earn. On this slide, red represents the total stream of payments for a borrower who chooses forbearance during training for 4 years. If they enter a 10-year repayment plan after residency, they'll pay over $395,000 just to eliminate their original $220,000 of debt. Based on a post-residency starting salary of $175,000, if they use IBR, shown here in dark green, they'll pay just $165,000 on their loans, leveraging the Public Service Loan Forgiveness Program as well. Similarly, if this borrower is eligible for pay-as-you-earn, they'll only pay around $110,000. Because these payments are income-driven, the repayment stream shown here remains true no matter how much debt the borrower has, making PSLF more attractive to those with higher levels of debt or those who train for more than 4 years. Looking a little deeper at the value of these programs, this slide demonstrates the economics of working in the nonprofit sector after training when loan forgiveness is contemplated. Here, a graduating resident is evaluating a nonprofit job offer at a $155,000 salary versus a for-profit job offer at a $205,000 salary. When the savings in loan payments is factored into the nonprofit salary, it becomes worth an additional $94,000 of pre-tax income for the 6 additional years after training. This chart highlights the savings for a borrower who works in the for-profit sector after training and utilizes the pay-as-you-earn program for 20 years versus entering a 10-year standard payment plan after medical school. A borrower with $175,000 of debt who does a 4-year residency and then obtains a $150,000 salary that grows at the rate of inflation for the next 16 years will save over $28,000 in present value dollars if they choose pay-as-you-earn over the 10-year standard repayment plan. As part of our free consultation services to medical students and graduates, we can perform this analysis for you based on your own debt and income expectations. I'll tell you how shortly. As I mentioned earlier, PSLF is only available for federal direct loans. For many medical students and residents, qualifying for PSLF requires a consolidation of eligible loans to direct loans. Considerations for loan consolidation are shown here. Recently, the Direct Loans Consolidation application was amended to include the IBR and pay-as-you-earn application. Now, with a single application, you can both consolidate your loans and enter IBR or pay-as-you-earn. It's important to be mindful of the considerations shown here as you navigate this process. Since IBR and pay-as-you-earn payments are based on AGI, married residents who file their taxes jointly with their working spouse will make higher payments than shown earlier. One way to counter this is to file taxes separately during training. In this case study, a borrower that gets married during their 2nd year of residency to a spouse with a $90,000 annual salary can have roughly $150,000 forgiven after 10 years. But by filing separately, these savings increase to over $230,000. As you can see, the proper utilization of these programs and related repayment strategies can have a significant impact on your financial position both during residency and beyond. Here is a high-level summary of activities that graduating students and residents must take into consideration as part of their strategy. While this provides a good overview, everyone's situation will vary, and an analysis based on your individual circumstances is necessary to make the best decisions. This concludes GL Advisor's presentation for medical residents. Visit glplan.com to receive a free personalized assessment and consultation that will highlight your savings opportunity and appropriate action plan on your specific profile. Shown here is a sample of a personalized assessment which GL Advisor provides for free to all medical students and graduates. Thank you for viewing this presentation, and feel free to share it with your peers. We are available most anytime, and you may feel free to contact us on our main line or by visiting our website or glplan.com.